Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. Now, our guest for this week's show is real estate investment expert Paul Beets. Now, Paul is the founder and CEO of Bigger Garage Capital, an investment firm focused on value add self storage investments throughout the country with a concentrated emphasis in the Midwest. In addition to his real estate endeavors, Paul is an engineering executive with GM who possesses more than 20 years of international leadership experience. And so, without further ado, I'd like to welcome Paul to the show. How you doing today?
I'm doing great. Thanks for having me.
Yeah, excited to have you here. Excited to learn a little bit more about your company, Bigger Garage Capital. But maybe Paul, before we dive into what it is that you do there and what your firm's focused in as far as self storage, maybe give us a little more of a background on yourself, kind of how you found your way into the real estate world.
Sure. Yeah. So I attended Purdue University, got an engineering degree. I've been working in the automotive industry for 20 some odd years. And so it got to the point where as I was moving up through the ranks, you start to realize that in order to move up, you got to spend more and more time with the company and less time with my family. And so I kind of had a breaking point where my wife was in labor with my second child, and I was in the corner on a conference call with Chrysler executives, and I said, "This is not the way I want my life to go." And so it was just shortly after that, my wife and I talked about it, and we said we got to figure out something different. And so I spent the past 5 years working to build a portfolio of cash flowing investments. We started out in single family, and we've grown and grown. And during the pandemic, everybody's familiar with the eviction moratorium. So I got a little concerned because I had about 20 doors of residential real estate, and I thought this is what everybody warned me about. This is how I lose my shirt in real estate, and so I wanted to pivot into a different asset class. And I picked up my partner Mike Margarella out of New York, and he and I decided to start going into self storage. So we have 6 self storage facilities in the Midwest, Michigan, Indiana, and Tennessee. And we just wrapped up our raise on a self storage investment fund, $2.5 million raise that we purchased several of those facilities in. And we're getting ready to open up a new self storage investment fund in March. Target raise is $5 million.
All righty. Well, fantastic. I appreciate the additional color there. Just would love to maybe dive a little deeper into kind of pivoting from the residential stuff over to self storage. I mean, there's a lot of similarities, but yet also a lot of differences. Self storage is very much more of an operational business than that of owning single family rentals. And so, talk to me about some of maybe the hurdles that you had to get through in order to get a comfort level initially, but then also just really master the business.
Yeah, you're absolutely right. Residential real estate, there's a lot of property managers out there, some good, some bad. I'm fortunate that I've got a very good property manager with my portfolio in Indianapolis. And so that doesn't take up a lot of my time, right? It really is as passive as residential real estate can be. But self-storage is very different because in many ways, yeah, you're buying a piece of real estate, but you're also buying that business. You're buying those tenants that are all in that property. And the way I used to do, I'd go and buy a house for 30,000 and I'd put 60 in it and then do a cash out refi and keep rinse and repeat the Burr method. So in self-storage, it's just doors, steel, walls and a roof. And so there's not a lot of improvements that you can do structurally like what you do in a house. And so a lot of when you're doing value add self-storage, you're doing operational value add. So you're improving the business that they were running. So that means implementing certain strategies, certain marketing plans to improve occupancy, increase rates, and find other ways of revenue that maybe the previous owner wasn't aware of, like outdoor parking, or maybe there's a warehouse on site that the previous owner wasn't renting, stuff like that.
Let's dissect that a little bit more. I come from the manufactured housing space, and we like to allocate, you know, you know, the value add strategies into different parts of the tree, right? We call it the low hanging fruit, the mid hanging fruit, and then the high hanging fruit. So it's harder to get to. And so for us, when we look at a turnaround or value add play, low hanging fruit to us would simply be market rent increases, buying something that's got, below market rents
Yeah.
and simply sending out a rent increase notice, which is the cost of a paper, maybe a stamp if you're sending it in that manner. And most of that additional revenue goes all to the bottom line, right? So that's fairly low
Right.
hanging fruit. Middle of the tree is more operational inefficiencies that we need to fix or implement new strategies. Definitely not overly difficult per se, but just timely. Timely. It takes a good bit of time to implement and integrate all those new techniques and strategies and see the fruits of that labor. And then the high hanging fruit for us would be infilling of new units. And so finding a park that's got 100 lots in total, just using an example where maybe 100 of the lots are fully developed, but only 50 of them actually have physical units on them. We
Right.
identified that there's enough demand in that marketplace to bring in 50 new homes. However, it's high hanging fruit because number one, it's very capitally intensive. Number two, it's got logistical challenge associated with it. And then number three, it's got lease up risk or sales risk, as far as how many can we
Right.
sell in a given month, quarter, or a year. Right. And so we kind of leave that at the top of the tree. And anyway, so would love to have a better understanding in the self-storage space. If you had to allocate in the same manner, what would be that low hanging fruit? What
Yeah.
would be the middle of the tree? And then what would be at the top of the tree?
Yeah, so you're absolutely right. Like right off the get-go, almost day one, our software will onboard all of the tenants that in that facility into our software, and then we'll just trigger rate increases based off where we think the market is at, right? We've already done in our due diligence and our pro forma where we think the market is at. So we'll get everybody raised to those rates, right? And it really depends on, what that value add is, where the rates were at compared to market when we bought it. And as we've bought bigger and bigger facilities, it's less and less mom and pops and more smaller and smaller operators, right? And so smaller operators are still keeping up with market. So that sometimes is a great value add, but sometimes not, right?
Mhm.
So, there's additional revenues pieces that are just as affordable or less capital intensive, like implementing insurance programs. So we require all of our tenants to carry insurance. Now, they're not required to take our insurance, but for the most part, they do take it, right? Because it's so much easier to do it our way rather than jumping through the hoops like providing proof of insurance does. So it doesn't cost any extra for us to offer that insurance.
Mhm.
We also do lock rental. So every single one of our units is going to be overlocked because we don't want people out there opening doors and storing stuff in there that they're not supposed to. So it's kind of a security assistance for us as well. But people go out there, they don't have a lock, they'll rent it for $2.50. So there's another value add, additional revenue that the facility was not generating. The other thing they'll add in there, and maybe this is the mid tier, right? That it's going to require a little bit of capital, but it's still pretty affordable, which is outdoor parking. So, we'll buy these facilities and it'll have a whole bunch of land, but there's nothing parked out there. There's nothing out there. Well, you threw down a few landscape timbers and a few signs, a couple $1,000s and a little bit of time from your maintenance folks. And now you can, basically sell off these pieces of land for $50 to $100 a month. So depending on how much land you have, and you get that parked up quite a bit for a very low capital investment. And then, like you said, and it really depends on, the type of buildings that are on the property. But one of our niches that we've been managed to end up in is most of our self-storage facilities has a commercial space that is attached to it. It's an auto body shop or a warehouse or, a commercial space where you can have suites divided. And some of those commercial spaces may be in, various stages of repair or disrepair.
Mhm.
And so we'll account for that and try to monetize all of the buildings and all of the spaces that are on the property. And that's really been a huge feather in our cap, especially as self-storage is becoming more and more competitive. Our facilities cash flow from day one, regardless of the occupancy of the self-storage, because we've got this commercial tenant that's kind of anchoring the property.
Got it. No, I appreciate that. And just I want to back up a little bit to, I guess what we would classify as low hanging fruit. You'd mentioned, selling insurance, not requiring that they use your insurance, but they have to have it. And so just, making it easy
Right.
one-stop shop by choosing yours. And then I think the lock rental program. Just curious, generally speaking, what type of margins are there in those types of ancillary income streams?
Yeah. Well, I mean, the margins for insurance, it doesn't cost us anything, right? I mean,
But you get a
we
kickback.
offer it.
There's some type of
Yeah, yeah. So I
monetary
mean,
incentive that you
um,
receive. So
there is. Yeah, yeah, yeah.
margin might not have been the best terminology, but just trying to get an
Yeah.
idea
So our
of
cut.
yeah, exactly.
Yeah. Yeah, our cut of the insurance. So I'm not comfortable saying it on a public, forum because we've negotiated pretty hard with some of our. But typically, like anybody that is getting started in the business, you can usually get a 40% cut of that of
Got it.
premium. So for every dollar, you're going to get 40 cents on the dollar, right?
Hmm.
And then, obviously we're higher than that because we have 6 facilities and we're growing. And so we're constantly negotiating with the insurance companies and we want a higher and higher cut. And of course, the insurance companies, they're looking for us to produce, documentation and programs showing that the take rate is at a higher level, right? So I would just say if you're in the self-storage industry, negotiate on those types of things because that could be a huge piece of additional revenue.
Sure. No, and it's been many years since guys, I can't remember last time I rented a self storage facility, and so, guessing that insurance probably runs $4 or $5 a month typically.
That's
My
we've got it's $12 for $2,000 of coverage.
Okay, got it, got it. And then lock rental. I'm actually I haven't heard of that one. That's interesting that someone wouldn't simply just go purchase their own lock. And what a beautiful business model. So 250 a
Well, so
month.
we're offering premium disc locks. Those disc locks are the most secure locks you can buy. And if you go down to Lowe's or Home Depot, they're going to charge you maybe $40 for a really nice disc lock. Well, we're only renting them for $2.50. So how many months is it
Yeah,
going to take for you to, are you going to stay there for 2 years? A lot of our tenants, when they move in, they have this idea that they're just there for a couple months. And
sure.
the truth is, and the beauty of self-storage is that's hardly ever the case. So
Hmm.
they'll come in with this idea, oh, I don't want to buy a lock for this. I don't know what I do with it afterwards. I'll just rent it for a couple months. 14 months later, we've gone beyond their break even. And again, we've got a little bit of additional revenue and all of our doors are secured that are vacant.
Yeah. No, but very interesting. And what is the average length of tenancy that you have found in your own portfolio?
Yeah, it's a couple of years.
Yeah.
I mean, I have to go back and take a look at some of our different facilities. It's probably, let's say, 18 months, I would guess, like across all of our facilities. But we have some facilities that 80% of our tenants are business owners,
Hmm.
and they're renting them out to run basically their business out of that. Landscaping folks, tree trimming, like mobile mechanic type operations. And so they've been at some of our facilities, we've got them 5 years, 7 years.
Wow.
So,
Well, that's a little
they're
different.
there for
That's
a
more like
long.
flex space. I mean, right. I mean, what you're speaking to is more like flex industrial
Yeah.
space than your typical self-storage. So is the majority of your portfolio made up of units such as that? Because I like that. I get that business model, and there's some similarities, but yeah, you're right. I mean, someone that runs a business out of that location, the chance, I mean, they're sticky. I mean, they need a location. It's not, hey,
Yeah.
I'm just going to temporarily store a couch here and a few personal items. Like their livelihood is
Right.
built around that space. And so I guess
Yeah.
what proportionate share of your portfolio and what you guys are doing is made up of that type of space, like that flex space versus just your
It's
traditional
very, yeah.
self-storage.
I mean, it is the building, the structure is a traditional self-storage roll-up door type of structure, but you're absolutely right. They're using it for flex space,
Hmm.
like what a business would rent out. In Indianapolis, where we're mostly based, there is a huge deficiency in flex space. And so what flex space is available is extremely expensive because of that. And so we do have, at least in the Indianapolis area, we have quite a few businesses that rent our facility out our self-storage units for that purpose. If you
Hmm.
look across our entire portfolio outside of Indianapolis, it's very low, probably 10 or 20%. But in one of our facilities, like I said, about 80% of the tenants there are flex space tenants.
Got it. Do some of the larger operators, Secure Space and Public Storage and those groups, do they typically have restrictions on allowing that type of individual to rent? So if they know that it's going to be utilized by, call it, let's just use landscaper, right? Where they're going to be there every day, they're going to be storing their mowers inside there. They're not going to be necessarily operating out of that, that they don't use that as their business address. However, that's where they store all their equipment, and they're going to be there every day in the morning and every day in the evening to put that equipment back in place. Do they frown against that type of renter, or do they allow that?
They they frown against you, and we do as well, using it as a storefront where your customers would come to our facility to buy something out of your unit, right?
Okay.
We don't allow that to run a business out of a unit. If
Sure.
you're using it for business storage purposes and you're there, like you said, 7 a.m. in the morning and 5 p.m. at night or whatever, I I'm not aware of any big
Okay.
operators that are going to frown on that, right?
Yeah,
The
fair
way we
enough.
see, the way we see it, those tenants are helping us keep an eye on our facility. We have camera systems, security systems, stuff like that. But those are some of the best people. They're there in the morning and they leave at night. We build a relationship with those folks and say, hey, if you see something, say something, right?
Hmm.
And so those are kind of a benefit to us that they're on the facility grounds. All of our facilities are ran remotely, right? So we don't have our own people on the ground daily. So I'm not sure how the big operators really see that, but I know that we definitely would frown about somebody running, a business out of the unit where customers are coming on the facility grounds.
Yeah. Yeah, self storage has been a hot commodity, for definitely the last decade, and just it's really been one of the darlings of the commercial real estate industry for the last 10 years, along with multifamily. Manufactured housing falls into that camp as well. In fact, there's a lot of similarities as it relates to kind of the evolution of both the self storage business and manufactured housing. Whereas it was just once 15 plus years ago, it was just a mom and pop dominated industry. Now it's got the likes of institutional capital and larger investment groups that have poured billions of dollars into the sector. With all that being
Yeah.
said, using a market like in Indianapolis, right, which is where you guys have a footprint. What is your
Mhm.
competitive advantage with your company when it comes to going up against the likes of a Public Storage, and you name it, right? I don't know what all the big operators I'm sure are in Indianapolis, and a lot of them, there's probably a lot of new development. Seems like just like car washes, new self storage development has really hit a stride over like the last 5 to 7 years with lots of new facilities opening up. And so, again, how do you stay competitive? What is your unique competitive advantage that you have against some of these larger competitors?
Yeah, so I mean, to begin with, we try not to compete with them, right?
Hmm.
And that is getting increasingly more difficult because what we'll see is we'll come into an area and some of the, mom and pop shops that are around us will get sold to some of these big REIT operators. But that being said, big REIT operators are just dealing with, when you're renting from them, you're dealing with a very large corporation. And that very large corporation, a lot of moving parts, a lot of people coming and going, and they have very strict rules that they just stick by, right? We're still, a family-run business, the way we see this, and so we have our own staff that answer the phone calls. Our phone calls are a broader window of time. And we have some flexibility with building those relationships with individual tenants that are, especially been with us for a long time. We run ours fully remotely. A lot of the REITs, especially when they get up above 300 units, they'll have somebody on site. So that's like an additional cost. But those people on site, they have no decision-making capability, right? They're just there to collect, rent and, answer rudimentary questions. Whereas, sometimes I'm answering the phones, right? We're, I would say, more nimble to be able to react and to support unique circumstances where other, facilities, they're just following the corporate standard, and that's that. There's no wiggle room on that. So,
Yeah.
we see that as a competitive advantage. Like I said, we're also doing things that some of the REITs aren't doing, right? We're really pushing the lock rental, and we're negotiating with those insurance companies. I don't know what the cut that some of the big REITs get. Um, but
Yeah.
we're in areas, we try to buy in areas that there aren't a lot of facilities, right? We're in the secondary markets or the tertiary markets. So, public storage, they want to be downtown, or they want to be like within the loop type of place. And we'll buy, outside the loop in a supporting market. And the big storage folks aren't getting there.
Yeah.
And then the other thing I'll tell you from like an investment perspective, right? Almost all of our facilities have those commercial spaces. So I know for sure that when we sell our facility, we're not going to be able to sell to a REIT, because REITs do not want to deal with those commercial spaces. They want to buy, sell storage, that's only sell storage, and
Mm-hmm.
that's all they're doing, right? It's just a stamp and go. So we're going to have to sell it to them a little bit more, bespoke operator that sees the value in having that additional revenue that requires a little extra management that public storage doesn't want to have to deal with.
Sure. No, that makes sense. What does your internal formula look like, for, buy decisions, as far as I know, secondary, tertiary markets. So you're not necessarily going direct competition with some of the bigger groups, but, are you looking, I guess, more specific? I'd love to know, when you look at a property that's mom and pop operated, you see some value, some opportunity in it. Maybe some of that value is, it's got some vacancies. Maybe it's currently running at 80% occupancy, maybe less, maybe a little bit more. But either way,
Yeah.
you see some room to run there, both with operational efficiencies, putting them into place, but as well as like leasing up vacant units. How do you make the determination? Is there a certain process that you go through to
Yeah.
get a confidence level to know that you're going to be able to take it? Like, this is not just it's not a market issue, and that's not why there's vacancies here. It's not a market issue. It's not that there's not a demand. It's that they've been running horribly. They don't have advertising. They're not doing things right. And so how do you make that determination?
Yeah. So, I mean, we do a lot of research on our potential acquisitions, right? So we're going to go look, do they have a website? Some mom and pops don't have websites, and it's not that difficult to even have a website. Do they have a Google My Business listing? Right? That's huge when you're trying to do online marketing and search engine optimization, SEO marketing, is if you have to have that Google My Business. If they don't have that, they don't have a website, then those are things from like, let's say they're at 60 or 70% occupancy, and they don't have those things. It's like, that they're doing pretty well in that market, and they're not doing any really serious marketing,
Mm-hmm.
right? We take a look at like secret shopper type of thing. Are they are they offering insurance? We're obviously looking for things about the property that maybe the owner's not taking advantage of. We've talked about the outdoor parking. We've talked about, we bought a facility from another large operator in Indiana, and there was a two-story building on the property that they were just using for storage. And so we went in there, put $20,000 into that building, put a small kitchenette and a bathroom in it, and then we rented out that as office space, right? So that's, we knew that before we bought the property. We knew that it had that office space capability. Now we were careful because office space right now is not in a great state, demand wise. So we were careful about including that in our pro forma. But when we're looking to analyze a property, we look for all of the different opportunities that we can bring to that property with our business plan that we've done elsewhere, and maybe what presents itself as part of the property, outdoor parking and such. And whether we can do rate increases and stuff like that. And we create a pro forma of how we believe that we can operate that property at a year, 2 year, 3 year time frame. And then we offer our number that we offer to them is based off of that pro forma. What kind of returns on investment, what kind of financing that we can get to acquire that property. So a lot of commercial investors say, "Oh, I don't want to buy anything that's a 6 cap or a 7 cap." We don't really care about cap rates. We don't care about current cap rates. We care about cap rates in the future based off of how we believe that we can get that property performing.
Sure. No, I'm definitely, I always say that, cap rate is somewhat irrelevant, at least on a value add property, right? I mean, if there's a,
Right.
a clear path value add plan, then going in cap rate to a certain degree is irrelevant. So I do agree with that. How about keeping up with with pricing in the marketplace, pricing as it relates to just, monthly rates of what your competitors are charging, incentives that your competitors are charging. Is there a program that allows you guys just to keep, your finger on the pulse of the marketplace, or is that not as relevant given that you're mostly in secondary and tertiary markets?
It's definitely relevant because, like I said, the market's constantly changing. Even in the secondary, tertiary markets, there's new players coming in, there's new facilities being built. It's a very fluid situation. Self storage, past 3 years has just been on fire. Like you said, if you go on you can go see all of the different self storage facilities that are being built currently.
Hmm.
So there's a lot of fluidity to the market. So what we do is there are some applications you can use out there that will automatically give you pricing guidance, for various size units. We don't pay for those. We have a sizable staff that is helping us manage these 6 facilities that they, as part of their daily or weekly or monthly tasks, they'll go out and sample the market, similar as if we were buying the facility again, right? We'll go and secret shop with facilities that don't have websites. We'll go to their websites. We'll look at what incentives they're offering. And we do that on a regular basis. So, in some of our areas, especially if we're doing a lease up, we'll sample that on a monthly basis. Where's everybody at? What incentives? And we try to undercut them, right? We want to be substantially below any of our competition in the area. Because the real secret to self storage and the benefit of it is it's very sticky. So when somebody moves in, they're usually in for a while, right?
Hmm.
But getting them in the door, if we have to get them in the door at a lower rate, a lot of people don't know this, but big REITs, the way they operate, they'll discount units substantially, and then they'll do rate increases every 6 months.
Hmm.
So we operate very, very similarly. So we're not as concerned with where the rates are at. We're concerned with getting people in the door, and once they're in the door, how quickly can we raise those rates up on them? And then
Yeah.
once you're, by that time it's too late. You're at 80%, 85% occupancy. Even if you raise your rates on these folks, there's going to always be a couple leave. But now you're at an occupancy and a revenue, level that it's okay to lose a few and add a few, right?
Hmm.
So that's kind of the way we operate our facilities. We try to undercut the local competition by quite a bit of amount, and then we do rate increases every 6 months.
Got it. Got it. No, that makes sense. I appreciate that. And on the acquisition side of things, just trying to understand some of the basic fundamentals of the business, and you're making the assumption that it's in a market that you like. and making the assumption, assuming a facility's for sale, it's in a market you like, and it's at a price point from the outside looking in, that would be a good value, right? Knowing those two factors, what are some reasons that would steer you away from actually acquiring that facility? What are some of the issues, or just items that just would make you say it's just this is not going to be a fit for XYZ factors? What might some of those be? Like for example, like for us, give an example, manufactured housing, all those, the other two things are, in place. Pricing seems right, market's strong. I know there's a demand for it. One thing I might uncover during due diligence is that the sewer system is completely failing, and we need to completely redo the underlying infrastructure, which is most of the time a multi-million-dollar endeavor, right? That would
Yep.
steer us away from a potential acquisition. Or what are some of those big gotchas or potential gotchas in the self-storage space?
Yeah, so one of them is, I would say a big one is zoning for us, right? And not just zoning, but the expectations from the local municipality regarding that property. So I'll just give you an example. We did end up buying the property, right? But the property, mostly gravel, some of it's paved, some of it's not, but mostly gravel. And, we always reach out to the local municipality to have a discussion with them. And again, these are value add, and so they do look a little dingy. They're still functional, like they're not falling down, but they're dingy. They need some paint and stuff like that. And so we'll reach out to the municipality and say, hey, we're thinking about acquiring this facility. What expectations do you have for this property, right? Like if we were to purchase this property, are there any zoning concerns? Is there anything that the municipality would like to see that they may impose on us? Stuff like that. We just talk about our business plan, what we're going to plan to do the facility. We want to beautify it. We want to make it look good. And so what we found is this municipality, because of the location, the land is probably worth more than the whole operation, right? We just got it for a very, very good price and a great location. The municipality said that they want the whole property paved. Well, the whole property paved is probably $100,000, right? So that would be a deal breaker, right? We don't have the $100,000, and you put $100,000 into pavement, there's not any additional revenue that you're going to get from that. Like even if I did, parking on pavement, the premiums parking on pavement versus parking on gravel, it's just not there, right? So it's like we're not going to put $100,000 into paving. So if you're going to impose that on us, we're out, right? So that's something that we would be looking at. And the other thing you just mentioned it is, we look at gotchas. When you're buying a residential property, you look at the big ticket items that are going to really, throw your numbers off. So, if the main line is a tile main line and potentially, collapsed, that's going to be a couple $1,000s, right? You're going to kill your cash flow for the next, 3 years, right? So I always would do the mainline scoping before I bought it. Same thing with self-storage. If it has a main line on it, one of the properties we bought, it had a commercial space and it had a septic on it.
Mm-hmm.
And that septic, the line that went out to the septic was not the right schedule size. So if you're imagining big trucks driving over it for self-storage, it could collapse that going out to the septic, right? So those are the kind of things that we're going to look at, and that could be a big ticket item. And what's the cost for us to make it right versus our overall business plan to squeeze as much revenue out of it to meet our business plan as possible. A roof self-storage, you're not talking about a small house, you're talking about roof that can go forever. And if it's not a metal roof, it's shingle. So you're talking, $30,000 to $60,000 of new roofs if you have to replace all of them, right? That could throw the business plan completely out of the water. So we're looking at those big ticket items, just exactly like what you described.
Yeah, no, that makes sense. Paul, what are you most
Environmental is another one, by the way.
Okay,
Environmental, I
yeah,
just thought,
I bet, especially if you have like, I can imagine, depending on how it was being used prior, but just
yeah,
depending on what folks might be storing there, if someone's not paying
yep,
attention, storing, fuel and oil and things of that nature, just different chemicals. So I could see that being
yep.
a potential hazard. Um, Switching the gears a little bit as we work to wrap this up, 2024 right around the corner. In fact, for those that are probably tuning in, it might be 2024 already. It might be a few weeks out from when we release
Yeah.
this. uh what are you most excited about?
So I'm really excited about. I'm starting to see the market soften a little bit with respect to buyers, and a lot of that has to do with bank financing has dried up to some extent.
Hmm.
I'm seeing LTVs down in the 50s and 60s. So it's the bank financing is scaring away a lot of operators from picking up facilities. So the demand to buy facilities is going down, but I still think that there's a lot of facilities out there that are for sale, or the owners are looking to sell. And so with that supply and demand situation, I think there's going to be a lot of opportunities to buy if you can get the right financing, right?
Hmm.
My partner and I don't have too many issues, especially now that we've built a track record of facilities, operating 6 facilities. And we've got relationships with several lenders that anybody off the street is not going to get the same terms as that we get, right? And so we're really excited about the opportunity to pick up some facilities, hopefully in markets that we're already in, so we can get economies of scale, leveraging our existing teams, and then potentially leveraging our existing financing partners as well. So we think that's going to be a kind of a competitive advantage in 24, with some folks bowing out. I can't do 50%, 60% LTV. I can't raise the capital to do that. Where we might be able to get 70, 75% LTV. Interest rates also are scaring away some folks, making it tough to make the numbers work. So we're really excited about that. At the beginning of 23, we bought 2 facilities in 23, and at the beginning of the year, there's nothing out there. I mean,
Hmm.
what was out there was being snapped up like crazy. Bank financing was still reasonable, and so now we're really excited about the opportunity to pick up hopefully 2 or 3 facilities in 24. And like I said, leveraging our existing processes and our existing teams and working with our financing partners.
Yeah, no, that's great. I appreciate you sharing. And Paul, for those that want to learn a little bit more about you and your group and what you guys have going on, where's the best place to track you
Yeah, so we do have a website, biggergarage.capital. So you can go check us out on that website. You can also email me, Paul, Paul, at biggergarage.capital. Happy to entertain any questions. We don't have anything out there yet, but we use a platform called Invest Next.
down?
And so we usually have our offering memorandums out there where you can go and take a look at the investment opportunities at biggergarage.investnext.com. So those are a couple ways that you can get a hold of us, and we'd love to work with anybody looking for cash flow. A lot of our assets we pay out quarterly, and we're really excited to be start our new self-storage investment fund in March.
All righty. Well, fantastic. Well, Paul, thanks again for joining us. It's been a lot of fun having you here. Appreciate it. And Happy New Year to you as well.
Same to you. Thank you so much.
Alrighty, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.